When you're dealing with a whole life insurance policy, whether it be a normal whole life insurance policy or a whole life policy designed for cash value accumulation, there are a few values that you may want to look at: the guaranteed values and the non-guaranteed values. And you may be wondering, what's the difference between the two? Today, we're going to do a deep dive on looking at a policy illustration and determining what it actually means for you going forward. Hi, I'm Olivia Kirk.
I'm Tim Urich. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
For the best advice on controlling your cash flow, be sure to subscribe to our channel. And don't forget to hit that bell to be notified when we upload new videos twice every single week.
When looking at life insurance policy illustrations, you'll often see guaranteed values and non-guaranteed values. What's the difference? Well, check out our latest YouTube video where we do a deep dive on guaranteed values versus non-guaranteed values.
Assuming you purchased the life insurance policy with a mutually owned life insurance company, you're going to have guaranteed values and non-guaranteed values listed on any policy illustration. Basically, the guaranteed values are the worst case scenario. How is this policy going to perform if there are no dividends credited towards that policy?
You see, when you're looking at a policy illustration, there generally are two columns. One column for the guaranteed values and one for the non-guaranteed values. The guaranteed values assume no dividends are ever paid in any year. The non-guaranteed values assume that dividends are paid at their current rates prospectively into the future. When you're looking at those non-guaranteed values, the only thing that we could guarantee is that those numbers are not going to be what you actually experience.
You see, that stands true for the guaranteed and the non-guaranteed values in most cases with these mutually owned companies. Because as soon as a dividend is credited towards your policy, the guaranteed values change. You see, the only non-guaranteed dividends are those that haven't been credited yet. Once that policy dividend is credited, it's set in stone. However, next year's dividend is not. That's to be determined. You see, these illustrations show you the worst case scenario and a scenario projected going forward, and a scenario projected going forward based on today's dividend scale. However, neither of those values are actually accurate. Leave us a comment down below. Do you have a whole life insurance policy, and how has it performed over the years? Does it match your original policy illustration?
You see, dividends could be better in the future. They can be worse in the future, meaning that they don't necessarily have to declare and pay a dividend. However, the companies that we recommend have been paying dividends for a minimum of 125 consecutive years. They've paid dividends through world wars, recessions, depressions. The assets of the life insurance industry actually grew during the Great Depression. So as bad as things got, the life insurance companies were a rock during stormy times.
You see, with whole life insurance policies, and one of the reasons why we love these whole life insurance policies so much is because they're actuarially designed to get better and better every year. They're not dependent on the stock market or other economic factors. They depend on the well-being and the profitability of the insurance company.
There are three things that are going to determine the performance of your policy. Number one, the insurance company has to assume that people die. That's assumed mortality. Insurance companies are really good at overestimating the cost or how many people are going to die. If there's a savings on the mortality cost, meaning people die later rather than sooner, that money gets to be used or transferred over to the dividend account. Similarly, the insurance company assumes that what it's going to cost to administer the policy. Again, they usually overestimate what it's going to cost, and any savings are transferred over to the dividend account. Lastly, then the insurance company needs to put that money to work. All of those savings get put to work or invested into various asset classes. And they use that interest rate that they earn on that money to further build the dividend account.
In conclusion, those illustrations that you see can and will change. One thing that is for sure, though, is that after you have cash value credited to your policy, you can't lose that money. If you'd like to get started with a whole life insurance policy designed for cash value accumulation, check out our website at tier1capital.com. Feel free to schedule your free strategy session today, or check out exactly how we put this to work for our clients and watch our free web course, The 4 Steps to Financial Freedom. If you like this video, be sure to check out these two. We picked them out special for you.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters. We'll see you in the next one.